Tobias Carlisle is a portfolio manager at the Acquirers Fund. Tobias, this doesn't look like good news for the value trade, which over the last year and a half really has been tied to rates. Days where bonds are down, value does well. So what's going on here?
Well, it's been the worst 2 months for value guys. There's a paper from Cliff Asness putting that out in what's been a pretty rough decade. So it's been very tough. We had a little bit of light yesterday, and so I told all the value guys on Twitter to make sure they got their victory lap in before lunch, just because we're going to be put back into the meat.
Yeah, the 25 basis point win yesterday.
That's it. Got to take them when you can get them.
So look, what's funny is, speaking of Mr. Asness at AQR, he wrote a post at the end of last year, I think it was, said, hey, I've written all of my career about the uselessness of timing, but the discrepancy between growth and value has gotten so ridiculous that it's time to time value. And then all of a sudden, that looked like the trade, Q4, reflation trade, cyclicals, that's a lot of the value cohort. All of a sudden this coronavirus hits. How long and how much of a deal do you think this is? Because if it's as big of a deal people are saying for the global economy, then I guess time to hunker down value.
It seems to be very serious for the global economy in terms of supply chains. I think that there are other issues, though. Japan had a very big negative Q4 GDP print coming in at negative 6.3% for the year. Yep. We've taken down our exposure from, we were at 160 gross, 100 net. We're now at 120 gross, 80 net. And that's led to us, we're trading a little bit. We haven't quite followed all of the value guys down, and the shorts have certainly been helping us a great deal. We've been looking for some names that might be particularly weak in this market.
So this is, and we've got the numbers here. It was ugly, right? For Japan, all the numbers have been pretty soft. Now, are you saying that that's total exposure to equities? Are you still short the stuff that you like to be short?
Yeah, so we're 100% long the value names because we still think there's a lot of value there, but we're 20% short in the fund, and we're short across about 30 names at the moment. And they've been working reasonably well in what has been a pretty strong market.
Now, this is, how do we weigh, because on the one hand, the kind of cyclical value trade is in need of, it seems, real growth, right? But then on the other side, for the short side, I know you like to short some of the frothier stuff out there. How about that? Are they really going to rally this time if the Fed cuts again? Or are they also going to say, you know what, this is a major problem for the economy if we turn around? How do you view that relationship in terms of what it means for expensive stocks?
Well, we look at, for the most part, we're looking at these names on a bottom-up basis. So we're looking for things that have already, on a name-by-name basis, that have some weakness in the stock price, because that's one of the things that we look for is some broken momentum. And so a name that we have discussed on the past on this show is Canada Goose, which has got problems that are unique to Canada Goose at the time that we were short. But it also has this China exposure in that they were expecting quite material sales and sales growth from Hong Kong and China that they've now said is unlikely to materialize. So that's further compounded their problems, and that's why the stock's been off so much recently.
This thing has been a great short trade. I know we've talked about the fundamentals here. How much more has this got to go? Goose has been getting punished. Toby, what's your target? Where's your out here?
Well, this is the crazy thing about Canada Goose. Even though it's off so much, it's a $3.4 billion market cap, $3.7 billion enterprise value, so it's net debt. And it's still trading on an EV/EBIT around 22 times, which is still pretty expensive for a name like this. It's a single brand stock that if people turn it into a North Face or something like that, it's going to look pretty ugly. Very expensive jackets into a weakening economy could be a problem. But we look at that every time we rebalance, and so we'll be rebalancing closer to the end of the first quarter, and then we'll see where it is then, and either keep it in or take it out at that point.
Okay, all right, and the chart looks pretty ugly. It's had a big downturn. Is there any support around $30?
Who knows? People like round numbers, but I sort of think that it's probably got a little bit further to go from here.
Yeah, okay. So you're still short Goose. We've talked about some of the other ones before. I know that, again, kind of have that kind of growthy trend, but you've got one that doesn't really fit that category. Conagra, I mean, we saw recently from the numbers and earnings, it was a pretty interesting report. The staples space, I don't think deserves the title anymore because so many are under deep disruption, and Conagra seems to be one of them. They got slammed the other day.
Well, they had come out saying that they were expecting 2% sales growth for the year, which is pretty anemic. And then they said that they've got some supply chain issues. The restaurants aren't taking that they've sold too much through the restaurants, so they're expecting growth of 0.5% to flat for 2020, which is why the stock's come off so much. It's one of those stocks that sort of sits in no man's land. It's a $25 billion enterprise value. $10 billion of that is debt. 6 turns to EBITDA, which, that's historically been pretty expensive and pretty heavily indebted. And I think with a kind of softening market and the sales going where they are, it doesn't really deserve even the multiple that it's on now, which is it's on around an 18 PE, 17 times EV/EBIT. I think it's one of those stocks that optically not that expensive, but could look more expensive if it gets as this little crisis rolls on.
Now, do you worry about the macro backdrop here? I mean, not to keep dwelling on it, but if the paranoia of the world coming under a serious halt due to virus is going to push people into staples. We were talking Coke before this, Conagra. Is that stuff going to matter? Is it going to get that kind of broad, sector trend underneath it?
Well, I wonder what happens to the fundamentals in a scenario like that more than what happens to the stock price. I still think it's, on those kind of multiples, it's still reasonably expensive, and I think they're digesting the recent acquisition. I think that it's a reasonable risk-adjusted short for here through to probably when we look at rebalancing next at the end of the quarter.
Yeah. All right, so Conagra short. Probably the higher it goes on this kind of fear trade, the more you're going to short it. Am I right?
We rebalance on a quarterly basis. We tend to rebalance back to equal weight on the shorts because you never know, you can get hurt badly on the shorts. So, for example, we've had a Tesla short on, which has been particularly nasty, but I think that it's a testament to the risk management in the firm that it really hasn't shown up in the results at all. To the extent that we've been hurt, it's been the long names and value just being soft through this period.
All right, Tobias, always good stuff here. Appreciate the update here. Short Goose, short Conagra from Mr. Carlisle at the Acquirers Fund. And look, this is a pretty interesting market, and we'll see if the value trade gets any more life. Right now, it's looking ugly. Toby, appreciate it as always. Thank you, sir. And go catch him on Twitter, of course,